Hi and welcome to another episode of JEMTrades. This is where we help kitesend your trading into profitability. So today we're going to have a look at some technical analysis and then move on to a bit of a personal story which involves family and opportunity cost. So without further ado, let's get into the TA. So this is what we had today. I actually didn't take any trades today. So this is what I was going to do, but it didn't happen due to some family issues. So we had a chop to knot here, and a chop to knot, for those who haven't checked out my blog, is just a term I coined for a certain type of choppy action. You can check out my blog, www.onlythemomo.blogspot.com, and you'll be able to read about this. But essentially it's just choppy action that breaks away into less choppy action in the form of longer bars and higher volume. So this is the point of action of the chop to knot, and you see we came back down and we tested that with wicks, and then we tested it again with a slightly lower low here. So the psychology goes something like this. Those who haven't seen this chop to knot or have ignored it for whatever reason, it's broken up, and for whatever reason people decide to go short. Maybe they go short here, maybe they go short there when they see a lower high. So here you have a high, then you have a low, then you have a lower high, then you have a lower low. So at this point people have, those who are short have some confidence in the downtrend because we have lower highs and we have lower lows. Then we go up and make what could have been, or what would have been, the third lower high. And you see wicks here, so that would lead people who follow candlestick lingo terminology would assume that this is rejection, and that this, if anything, was going to be the third lower high. Then we make a higher low, and this starts to worry the bears. And then this is the turning point right here. If you're short and you see this high taken out, that's where you start to get concerned about your short position. And you see we come back down, we hold that level with some rejection in the form of wicks. We make, on this micro trend here, we make a higher high. We've already got the higher lows here, and then we make a third higher low. And so this is the point where if you were a short from way back here, anywhere here or here, and you see this scenario, this is where, as we mentioned, this was the turning point here. This is where you want to see follow through to the downside. And once you get that rejection there, that's where the shorts are going to have to cover, because it's clear that their short isn't working. And in fact, you see volume come in here, and the market moves up in nice, relatively long green bars up here. So that was the idea behind the 5-minute chart, and there was a 30-minute backdrop which I won't go into, but that makes up part of my methodology. So I was looking to go long here on this reversal candlestick when it closed, which was 1.2292 right there. So that's 6B, 92, that's 6B. Now let's look at 6C. Again, we had a 30-minute backdrop, but for the purposes of technical analysis, I'll just share with you what I saw on this 5-minute chart. And you could very well just trade using this information. You don't necessarily need the backdrop, the 30-minute anchor chart, although that will help you in running your targets further. So you got uptrend, nothing special about that. And then you see pace starts to slow here. And by pace, I mean the amount of price covered on the y-axis. If you were to draw a triangle like this, there's a longer period of time, the x-axis, as compared to it's the ratio between the length of time, the x-axis, and the rise in price, the y-axis. So this is lower pace than this, because this has more time for your price rise than this does. So you could use trigonometry and all that stuff, but it's just enough to see visually whether it's whether it's leaning over more or not. So when you see something like this, that usually means that the bears are taking over, because there's more bars for less price rise. And you can also use volume to quantify that. And then you see a break here, a chop to knot, as we mentioned last time, and the bars get bigger and volume comes in. So this is where resistance has given way. The bears are now panicking, they're covering, and new buyers are jumping on board right here. So this is your first zone of action. And remember, we had the higher lows and we had the higher highs. So this is the pivot point that you want to watch. So it goes up, it wicks up here, turns over with pace, comes back down quite heavily, but then rejects that with a series of wicks right at this level here. So now I know, I don't know, but the probabilities tell me that it's long. So I was looking at here, looking at candles, and I'm looking to see a rejection of the downside. So these candles are showing down. You see upper wicks here, it's pointing down. Another one here, and then all of a sudden this candle right here, I'm not sure if it's visible on this video, but this one right here that I'm pointing to, it closes above the wicks, above this last wick of this cluster of 1, 2, 3 wicks. So that's the first sign that we're going up. And then you have this candle which is suggesting down, and then finally we get a change in polarity, which is this hanging man candlestick here, which would be a hammer if it were at the bottom of a trend. This one that I'm pointing to here with the small body on the upper portion of the candle and then a lower wick, and that is changing the polarity, because beforehand we had wicks going against our position, our proposed long position, and then we had a close above and then a reverse or change of polarity so that the wicks go in our direction. So you could have got in there at 510.5 it was, I remember, 510.5 here. So this happened around, what's that, 5-ish, coming up to 5 o'clock. And the other trade that we had, 6B, was around that time, I believe, coming up to 5. Yeah, 4 to 5. So that was 4 to 5. 6C was 10 to 5. So we had 2 trades coming at the same time. The target on this 6C was 17.5 pips, or 528. So from 510.5 to 528, and then the 6B was from 292 up to, the target was to 330. 292 to 330, 38 pips, we had 10 pips risk. And I didn't get either of them, and this is the other part of this story that I wanted to quickly share. It's imperative to have your family situation sorted, and if things do go wrong, you need a contingency plan. And why is that? That's because usually our son, Dante, is usually with his mum, my partner, downstairs, and she knows that when it's trading time, I need to be available and I need to be on point. But this time, because through misunderstanding, miscommunication, she assumed that I was asleep in my office, so she put Dante to sleep in our bedroom. He woke up, she was asleep, and long story short, I had to go and change him just as these trades were setting up here. And by the time I got back, they were right there. I could have just about got in both of them, but with the rush to change his nappy and change his body, and he messed himself up a bit, and I had to quieten him down. He was crying, and by the time I got back here, it was just a tad too late to get into these trades, or at least I didn't feel comfortable just clicking them in without reviewing the situation and making sure that what I was seeing is what I needed to see. And so that cost me all said and done, that nap that Margie, my partner, took cost the account $300. So I think that counts as the most expensive nap that she's taken so far. And what I would do in the past when these sort of things happened, and this time it's on real cash, it's not on sim like it used to be, or combines. And what I would normally do is just try and fight back. I would demand that the market give me the missing $300 in this case, or the missing 100 or 150, 500, whatever it was, and take suboptimal trades. But today we've got the FOMC is currently coming up to 21 minutes to 7 here in Italy. FOMC comes out at 8 p.m. here in Italy. So I may allow myself one trade, and if that stops out, I'll leave it there, because the last thing you want to do is draw down to your daily stop, and you were supposed to be up 300 and you end up down 300 on the day, because that makes a net negative difference of $600 rather than the 300. So the message, the take home for this story is to reduce the damage. Have a contingency plan in place. So I know what I'm going to do when I shut down the station. I'm going to go and have a bath, because I once read in one of Steve Nissen's books that the Japanese, when they have either a big loss or a big win, any emotional extreme, so I'm clearly, obviously frustrated that I missed out on $300 today, but just to mellow out and calm myself down, I'll just take a nice hot bath, read a book, listen to some music. I might watch a film, one of the films I've downloaded, and then go to bed early and be ready for the next day. Because the last thing you want to do is get yourself in a mess by digging what would essentially be a deeper hole, because if I'm already missing that $300, then anything I do to exacerbate that just makes that loss bigger. So that's the message for this video. I hope you got something out of it. Like, subscribe, and do all that fun stuff if you enjoy this kind of thing. And don't forget to follow your plan, keep it simple, and keep on track. See you next time.